Beyond the basic index fund, the 20th century saw the creation of a number of different kinds of specialty investment pools that enabled investors to channel their savings into a variety of different asset classes aside from simply the stocks and bonds which had previously been available to them. In fact, some of the most interesting pools involve the use of different kinds of assets that investors might not have traditionally purchased through a stock exchange. And these included the sorts of things like private equity funds, the first of which got created in 1946, a venture capital fund called American Research and Development Corp. The idea behind George Dorio's fund was to try to provide financing to a number of small firms which had traditionally been shut out of corporate financing, not necessarily large enough to attract the attention of large banks, but promising enough that they might someday be able to ultimately grow to provide significant shareholder value. So recognizing that there had been sort of a hole in capital markets, Dorio's fund moved in to try to provide early financing support, and as a result, provided a vehicle through which investors might be able to gain access to these kinds of early stage businesses, as opposed to simply buying the mature ones which were listed on a stock exchange. Another interesting innovation from the 20th century was the creation of real estate income trusts, or Reits. These first appear in the 1960s in the United States, and they give opportunities for individual investors to participate in the financing of commercial real estate, earning a portion of the rent on things like malls or office buildings. They first appear in Canada in 1993 in response to collapse of Toronto's last real estate bubble. Interestingly enough, from 1989 through 1994, we see an inflation-adjusted decline of 30% in Toronto housing prices. You can see this graph at the top right-hand side of the screen here. The image of my face might be blocking it, but there's a gray line that rises quickly here towards 150,000 in 1989 and then declines down towards 90,000 by 1995. This is the inflation-adjusted to 1980 housing price in Toronto, where we see significant declines from its peak. And in fact, we don't see a recovery of that price on an inflation-adjusted basis for almost 20 years. Now, REITs were introduced in Canada largely to help provide support to commercial property financing during this particularly challenging period when people were essentially fleeing real estate investments in Toronto, both commercial and residential. As you can see, across most of the rest of the country during this period, on an inflation-adjusted basis, housing prices largely traded sideways until roughly 2002. Nonetheless, the introduction of REITs in the early 90s did enable investors to channel some of their savings towards commercial real estate, but most importantly, also made it possible to finance commercial real estate expansions at a time when most people were avoiding the market entirely. Now, there are, of course, even more specialized funds than this. At the links below, you'll see that there are examples of funds that are focused entirely on speculating on the prices of bottles of wine, others on master works of art, and yet even others, which were being floated in November of 2020, some had even suggested starting a fund that was based on the price of underlying sports cards, which could be traded. Another piece of evolution that we see in the fund industry occurs in 1989 with the creation of the first exchange-traded fund. They were originally created in the United States, but the first one that was rolled out was ruled to be a futures contract at the end of the day on the price of the underlying index. And thus it didn't acquire the same kind of market traction that its neighbor did in Canada. The following year, the Toronto Stock Exchange issued what were called index participation units, which allowed people to buy into shares of the largest 35 companies traded on the Toronto Stock Exchange by buying just a single unit of a fund that would be traded over the exchange itself. The Americans caught back up to their own innovation in 1993 when State Street finally rolled out the ever-popular SPDR, or Standard & Poor Depository Receipts. Now, these exchange-traded funds are really a new breed. They are a cross between closed-ended funds and open-ended funds, in the sense that their units are traded on an exchange like shares of a stock or like units of a closed-ended fund. But should the underlying asset value of the units start to diverge too much from the price of the units themselves, then there's an opportunity for brokers acting as arbitrageurs to either redeem units with the issuer of the ETF or to have new units created. So in this way, we have all of the benefits of an exchange-traded security like a closed-ended fund, but without the complication of having its NAV deviate from its underlying asset value. Now, many ETFs follow a simple index fund strategy as laid out back in the 1970s by John Bogle. And as a result, they tend to carry fairly low management exchange ratios. Nonetheless, it is important to note that ETFs are not the same thing as an open-ended mutual fund, and therefore they're not met by the same kinds of regulatory restrictions, which means even though most ETFs might trade as an index fund, there are some very specific ETFs with other strategies and other kinds of risks that people ought to be aware of. For instance, ETFs are allowed to use leverage in a way that open-ended mutual funds are not allowed to, creating the category of beta pro ETFs, which ultimately leverage return on an indexed product. You have negative return ETFs that are effectively short selling the index, offering an inverse return of what a long investor would have earned by buying its sister ETF. You've also got ETFs that can invest in currencies, ETFs invest in commodities, and even ETFs that ultimately trade derivatives in a way that we simply can't do with an open-ended mutual fund. On top of all that, we've started to finally see the creation of actively managed ETFs, which is a portfolio that is actively being adjusted by a manager, but nonetheless follows the same kind of ETF format of only having units be created or redeemed when their underlying asset value deviates from their market price. Now, actively managed ETFs are relatively new in the space, but they are growing quickly and attracting a lot of attention. As of early 2021, they represent roughly 2.5% of the total amount of ETF assets that are out there. But we have one final specialty product that I think is worth discussing as well, which has become particularly popular in China over the last decade and a half. And these are what are called wealth management products. Wealth management products are effectively portfolios of high yield loans that banks have tried to move off of their balance sheets by selling to individual investors. Now, the market for these securities has swollen dramatically. Originally, people were pushed into this market because the interest rates on their deposits was actually less than the inflation rate. And so people in China who were hoping to save money were ultimately required to move their money into riskier investments, things like wealth management products or real estate speculation or the stock market. And as a result, these wealth management products have seen huge swelling of interest among the investing public for a couple of reasons. First off, most of these wealth management products are being sold by large state-backed banks. And this has led a number of people who are buying them to believe that these products will be guaranteed as closely as a deposit is guaranteed by a state-backed bank. And this is simply not the truth. While the banks may act as sales agents, they don't always administer these kinds of products, and nor are WMPs backed by the same kinds of deposit protection that deposits are. Now, of course, the government has recognized that people have this sort of flawed thinking and has tried to take some steps to tighten up regulations around wealth management products in the last few years. But nonetheless, the space has swollen dramatically from being roughly $160 billion US at the turn of the decade to almost $4 trillion today, most of which has been lent to property developers and local government businesses, which have a relatively high degree of risk, much higher than is being anticipated by the average investor in these products. It's important to know that when you see new kinds of products being developed, that there are often risks that need to be concerned that aren't always directly apparent to individual investors. So always be careful to read the prospectus associated with any kind of security you might buy and be sure to understand the risks that are involved.